Glyn, Happy New Year to you.
Thank you.
Before we look forward into the year 2014, let's take a moment just to reflect on what was an interesting and a rewarding year for investors.
Well, a very good year for investors. I've no doubt that the returns, particularly from developed equity markets, far exceeded the expectations of nearly all investors at the beginning of the year. So it was a very good year, but some big divergences in performance in the course of the year, with developed equity markets performing extremely well. MSCI World Index up 27% in dollar terms, a very, very good year. But in contrast, we saw emerging equity markets actually down in the year by a few percent, and just as we expected, negative returns from global government bonds. This stage we're getting to in the cycle now, where interest rates on bonds are starting to move up, produce negative returns in that sector. So a very interesting year, but generally speaking, a good year for equity investors and a good year for multi-asset investors.
Quite. We'll take a look at the various asset classes returns a little bit more in detail in a moment. Before we do that, let's look at the backdrop. Let's look at the macro picture for the year. A number of key themes. Would you like to highlight any?
Yes, look, there's no doubt when we look back on 2013, this will be the year that will be remembered for the time when the Fed in particular started to the whole process of unwinding this ultra-loose monetary policy that's pursued, this extraordinary policy it's pursued since basically Lehman's went bust in late 2008. So 2013 was the year when the process of unwinding that started in a very, very modest way, but of course it had a big impact. As soon as the Federal Reserve made that announcement back in February of 2013, they would start to taper. It had a big impact on markets globally. In terms of the economies globally, it panned out pretty much as we expected. A very slow year for growth, pretty sluggish in economies, but the developed world improving as the year went on. And it was sluggish for all the reasons we expected. We had fiscal headwinds, we had the sequestration package at the beginning of the year in 2013 in the US. We've had this whole process of deleveraging going on, and as we've said so many times, deleveraging means saving more, spending less. That's a long-term process. Some countries have been quicker at getting through that than others, and the two in particular are the US and the UK, where we will now begin to see some better growth coming through. But generally speaking, subdued global growth. Relatively weak growth in the emerging world, the slowest growth rates we've seen there for quite some time, with some quite big structural headwinds that are faced there, some credit issues that are being faced in some of the big emerging economies. And overall, I think the other big factor that might have surprised a lot of people was what happened to inflation. Many people have been expecting this very long period of very loose monetary policy to result in higher levels of inflation in the real economy. That has not happened. The only inflation we've seen to date has been in financial markets. We have not seen inflation in the real economies. Indeed, we've seen the reverse. We've actually seen inflation falling in the course of this year. So global inflation came in at only just over 2% in 2013. In the developed world, it was only 1%. And in parts of Europe, peripheral Europe in particular, we've had a deflationary environment. So I think that's the other quite big surprise that we've experienced in 2013.
On the subject of deflation, Japan saw a glimmer of inflation, which is a bit of a change of tack.
Yes. Well, inflation finally went positive in Japan after the best part of a decade of negative numbers. And of course, the start of 2013 was really the start of Abe, the new Prime Minister's Three Arrows reform program, two of which, the fiscal spending and the monetary policy reforms, have been very significant. And at the beginning of the year, we saw the Bank of Japan step up to the plate in terms of quantitative easing. They're purchasing bonds at the rate of $65 billion a month. They're going to continue to do that for a long time to come yet. And this is now having an impact. The yen fell significantly. It's one of the weakest currencies in the world, down about 18% in the year. And all of that helped the Japanese economy to begin to recover, but it also meant inflation picked up a little bit. It's not an issue in Japan still. Their focus is getting away from this long deflationary period. So it's just turned positive. The economy didn't do too badly. It grew by about 1.75% in 2013. So I think so far you've got to say that the Abe reforms have worked. Probably 2/3 of them have worked pretty well, and there's no doubt they're going to persist with that in 2014.
An important factor when it comes to inflation is, of course, the commodity inputs to that.
Yep.
A very interesting year for the likes of gold and oil.
Well, yes, and given what happened to the global economy, pretty subdued growth, and the emerging world in particular slowing down quite a lot, China falling to growth levels below 8%, and I think likely to fall further than that. But all of that meant that at the margin, the demand for commodities was quite weak. So we saw most industrial metal prices falling. Gold had an extraordinary year, the first negative year since the year 2000, and a big negative, fell by 28%. Why did it do that? Well, inflation wasn't a problem. The Fed's tapering decision had quite an impact on the gold market. There's no doubt that we saw reduced demand when the price was close to $2,000 an ounce. So it had a very sharp fall. It was the sort of conditions where you might expect gold to be pretty weak, quite frankly. And the oil price was broadly flat over the year, although the pressures downwards on the oil price, I think, increased as the year went on, with some geopolitical issues having a factor, and this sluggish growth being an important issue for the oil price. So, if anything, the oil price looks to us as if it could well fall a little bit further in 2014, frankly.
Let's move then back to the securities markets. You mentioned them already. A big and an important performance differential between developed markets and emerging markets.
Absolutely huge. The biggest we've seen for a very long period of time, about a 30 percentage point performance differential in the course of the year. Some emerging markets fell by 15-20%. Brazil, Chile had very big falls. There's a lot of those countries that were commodity dependent, and emerging markets are suffering from a number of problems. The most important, I think without question, is the sort of the credit and debt boom that they've had in recent years, and that's got to be unwound. It's become excessive, not as excessive as what we saw in the developed world in those 5 or 6 years prior to 2008 when Lehman's finally went bust, but nevertheless there are some credit issues to address. There are structural reforms that the emerging world has generally been slow to implement, and we've got to see more of that. So we've seen current accounts moving into deficit, we've seen currencies under pressure. All of that has had a big impact on the emerging world. So it's a very timely reminder that the US remains by far the dominant force in the global economy and by far the most dominant force in global markets. And people shouldn't get carried away with thinking that emerging markets will always produce superior returns because they're going to produce superior economic growth. That's definitely not the case. Very good example in 2013, say this big performance differential. And I think we might well see a little bit more of that relative weakness as we go into 2014.
Sticking with markets where the US is a dominant force, the sovereign bond market finally had a negative year as well.
Yes, well, we were not in any way surprised about that. The level of interest rates on government, safe haven government bonds, US, UK, Germany and so on, as we entered 2013 was at historically extremely low levels. And with the first hint of tapering from the Fed in May, we saw interest rates on 10-year treasuries nearly double. They went from roughly 1.5% to about 3%. They closed the year at about 3%. Now, obviously, when interest rates go up, capital values fall, you've had a negative return from treasuries and other safe haven government bonds. So, in fact, the global government bond index was down about 4 or 5%. The first negative calendar year return, incidentally, this century from global government bonds. Not very often we see that. So I would see that as the beginnings of the process of a return to more normal conditions in global government bonds, where interest rates will get back to slightly more normal levels. Remember, interest rates in real terms have been running at negative levels in global government bonds for quite a while. They've only just now gone slightly positive. So there's still room for global government bonds to weaken further, in our view, as they do return to more normal sort of pricing levels.
Other income-sensitive asset classes, property also had a pretty poor year.
Property had a poor year. It had done well. Property securities had done well in the years post the Lehman's crisis, but returns were quite subdued in 2013, up about 3.5-4% from global property securities. And I think that, as you say, was largely because people saw the return, the yield on government bonds picking up. That had an impact on what is essentially an income-producing asset. Other areas, incidentally, of sort of income-producing sectors in the fixed income market in particular did reasonably well. High-yield bonds, where we've been positioned in a big way for quite some time, yet again produce a good positive return, about 7 or 8% in US dollar terms. But generally speaking, the bond asset class was weak relative to developed market equities, and income producing asset classes were also relatively weak, property being a good example.
So a subdued growth environment, but still an environment where equities could flourish.
Yes, I'm conscious of the fact that it's a bit of a consensus view, but I do think that we are in an extended economic cycle here, and that's a very important point to bear in mind. There are really no signs of excess. I know people are worried about sort of bubbles being created by what's happening to monetary policy in central banks, but there aren't really any signs of asset bubbles being created, with possibly a few exceptions. The prime residential real estate in London might be a good example, possibly Hong Kong real estate, that sort of thing. But isolated examples are not really big in the overall scheme of things. Generally, we don't have asset bubbles, and we've got an environment where you've got the beginnings of a slow recovery out of this long slump post-Lehman's, but you've still got headwinds. You've still got the deleveraging process going on, not at quite the same pace, but it's still going on. That is a brake on growth. You've still got fiscal headwinds, again, not at the same pace as we've seen, but they're still there. So this is not an environment where growth is going to accelerate away to such an extent that monetary policy is going to be abruptly tightened to choke off any growth. Inflation remains very subdued, and it looks to remain that through the course of the next year. So all of those factors suggest to us that we will see quite an extended business cycle here, where the economy recovers gradually without actually introducing any real bubbles and concerns. So I think 2014 will be another quite reasonable year. Will it produce, as we saw in the US, Europe and Japan, 30% returns? I think that's extremely unlikely, because remember, corporate earnings have not matched that rise in share prices. So valuations have moved ahead over the past 12 or 18 months. I don't think they're extended, but I don't expect them to move ahead again at the same pace. So yes, I think we'll see positive returns from equity markets, led again this year by developed market equities, but we won't see 25 to 30% returns. It's going to be more like, I'd say, 8 to 12, 15% returns. And later in the year, as the emerging markets begin to get through the problems they're currently challenged with, I think we might begin to see some better performance from the emerging market world. A little bit early to expect that yet. And what I'm very conscious of is the fact that when you look into the emerging markets, the stocks that you still want to own, the consumer staples, the areas where you're going to get the best long-term growth, are still relatively expensive. The ones you don't want to own are the ones that are very cheap, that bring values down. So a little bit of caution there in the first half of the year. But generally speaking, I think we're in for another quite reasonable year for equity markets, led by the big developed market equities, but not a great year for bonds. I think this process of interest rate normalization in the bond markets is going to run through this year, and we'll see possibly another small negative number from global government bonds in 2014. Possibly from these interest rate levels, you might have enough sort of income from the bond just to compensate for the capital loss, but not a great year from bonds.
Sticking with bonds particularly, interest rates, central banks will continue to dominate the headlines in the coming year?
Absolutely, without a shadow of a doubt, as they have done for a few years now, and certainly in 2013. I'm conscious of the fact that we are now into the process of tapering. In December, the Fed reduced their asset purchases. They will start in January this month by $10 billion a month, but they're still purchasing securities at the rate of $75 billion a month. The Bank of Japan is doing the same thing. The Fed has made it clear that they want to end this whole process of asset purchases, QE, and they intend to reduce purchases as the year goes on. I think they'll be actually quite slow in doing that. It'll be data dependent. They're looking out for the employment numbers in particular. But what they've done to balance that sort of process of tightening is to make it very clear to the market that there's going to be no change in interest rates for a long time to come. What they call forward guidance has been materially strengthened. When they said in December, right at the end of 2013, that they will not raise interest rates at the short end until unemployment is well through 6.5%, so a clear strengthening of forward guidance. I think it's quite likely that not only will interest rates not rise at the short end in the developed world in 2014, quite possibly not in 2015 either. And again, that's a very supportive backdrop for equity markets and economies.
Thanks, Glyn. So in conclusion then, probably a good year for equities ahead of us. a more challenging year for parts of the fixed income market, and a supportive environment generally for equities?
I think that's broadly right. I just caution, we've had an extraordinary year. We've had a 30% gain, broadly speaking, from the developed world in equities. That's not going to be repeated. If it is, I would actually start to say there's an asset bubble developing. But I certainly think this cycle has got legs. We've got plenty of time yet to run through this cycle. We're by no means at the end of this recovery in economies, or at the end of this bull market. We've got some time to run. But clearly there are going to be bumps on the way. As the Fed commences the process of tapering this month, the markets will be a little bit more nervous about that. I think that could have an impact. And of course, any misstep by the Fed would have big implications globally, as we saw back in May of 2013. So I think we are going to get some significant bumps on the way. They, I think, would be quite interesting opportunities to buy into equities again. There's more to come from equities yet.